I'm Matt Eagan, Director of Federal Affairs at Stage Trust, the federal arm of the Texas Public Policy Foundation. Joining us today is E.J. Antoni. He is a Senior Research Fellow for Public Finance. He's a Research Fellow and Public Finance Economist at the Heritage Foundation. He's this really strong voice for fiscal sanity, and that's really what we're here to talk about today is the Biden economy and how it's really impacting everyday Americans at home. They know that they're seeing it, but I think sometimes we all just need to explain to us a little bit how each of these things impacts and leads to that. So we're really glad to have him here today. But the most important thing about EJ, obviously, is he's a TPPF alumni, so we're glad to have him back with us.
My pleasure. Thank you for having me.
So like I said, we're here to discuss kind of the health of the U.S. economy and what the changes the Biden administration has done and Congress to lead us where we are today, where people pocketbooks are tighter than ever. So how has the Biden administration really manipulated the U.S. economy? I know it's a broad one, but let's start big.
I think the biggest thing has been inflation, which has come from the government spending, borrowing, and creating much too much money. And so the result of that is it's kind of like pouring water into wine. Yes, the total volume of liquid is increasing, but the actual concentration is going down. In other words, the value of the individual dollar is going down, and there's more dollars. Why? Because the wine hasn't changed, right? You haven't actually increased the volume of wine. You've just diluted it into more cups. That's basically what's happened. The actual value, which is the size of the economy, how much we're producing, that hasn't changed. We're just changing the amount of money. And why would the government do this? Because it's a way for them to siphon off some of that value of every single dollar into their coffers, which allows them to spend more.
Well, that's just a bleak reality, unfortunately, but I think that's a really great analogy. So when we look at obviously every month we get the labor statistics that the media just props up the administration with. So we got our last statistic. So how is the Bureau of Labor and GDP figures? How is that part of this manipulation? How do we see that manipulation in these numbers?
Well, with GDP especially, part of that is government spending, or government expenditures, I should say. So as government expenditures go up, it increases GDP, which is just one measure we try to use for the size of the economy. It's the expense side of the equation. The income side of the equation would then be GDI, which is income, as opposed to GDP, which is product. So essentially what's happening is as the government goes further and further into debt, something like about $1 trillion every 100 days, absolute breakneck pace. But as they do that, they are effectively buying a GDP number. And the scary thing is that it's nowhere near a one-to-one. Part of that's because government spends its money so inefficiently because a bureaucrat doesn't really have an incentive to spend money wisely. He's typically spending someone else's money on yet another third party. But what's essentially happening is you are going further and further into debt to buy a relatively small amount of GDP. You're getting cents on the dollar. In terms of the jobs numbers, you're seeing something similar in that as government hires more and more people, directly or indirectly, you're increasing those headline jobs numbers. Why do I say directly or indirectly? Because the government can obviously hire someone and you work directly for the government. But you could also hire someone indirectly. We see this a lot in healthcare, an industry that is just dominated by government. So all of this money goes from the government to the healthcare industry, whether it's a hospital, an insurer, you name it. Those businesses then hire people using the funds that they got from the government. So you could say it's an indirect hire, because if you took that money away, those jobs would also go away. And what's scary is that over the last year, for example, government direct and indirect hiring accounts for half of all job growth in the entire economy. That's particularly troubling because for the government to hire somebody, you need a lot of private sector employees to enter the workforce, because you need to take taxes from each of those people to pay for that single government employee. Let's just say everyone's making the same amount of money, just for simplicity, and you're going to take 5% of each person's pay in order to get the money to pay for a single government worker. You need 20 private sector workers now to pay for that single person working for the government. We are nowhere near that ratio.
So what you're saying is we're funding these government jobs through that deficit spending you mentioned. That $1 trillion every 100 days is funding government jobs where they're spending more money, but yet I don't think Americans are seeing that money in their daily lives in any sort of beneficial way.
No, exactly. It's absolutely right. And it's one of the reasons why you can have such good headline numbers and then the polling on the economy can be so terrible, right? There's been an unprecedented disconnect lately, and that's one of the reasons why.
Oh, I think that's a really, really strong point. We obviously see the White House and the media trying to prop up, Bidenomics and the Biden economy, but people at home are really confused because they see that on the media, but then they go to the store and they see that they're buying the same groceries, but it's costing them considerably more, and they're looking for places to cut back, which is something that makes you really think what is going on. So they just see that incongruency every day. So it's really great to have a way to have that explained.
Mm-hmm. And one of the scary things, talking about grocery prices and food, if we can go down that rabbit hole for a second, you have these two things that are really combining, I think, to just absolutely wallop low and even mid-income earners. On the one hand, you have what you could call, I guess, an income effect. So everyone's income has effectively dropped because of inflation, right? My dollar can buy less because the dollar's not worth as much. One of the tools that money functions as is a yardstick. And if you shrink a yardstick, it's going to take more of those yardsticks to cover a football field, right? Mm-hmm. So as you shrink the value of money, it takes more money to buy the same amount of groceries. And so that's the income side of the equation. But then you have a substitution effect as well. And what's happening there is, let's say a middle class or even upper middle class family would normally buy, a nice cut of beef, like a fillet every week or something like that. And they're looking at their budget and saying, oh, wow, this isn't affordable anymore. And so what do? They buy something like ground beef instead. So you now have a substitution where people are buying more of the things that were disproportionately bought by poor, by lower income folks to begin with. So you now have this increase in demand, which is driving up the price further on top of the inflation, which you already see. And so luxury goods tend to rise slower in price during these periods of high inflation, and basic necessities tend to rise faster. And sure enough, Biden's own Bureau of Labor Statistics actually breaks down the CPI, or Consumer Price Index, among income quintiles. So they break it down from the lowest to the top fifth of income earners. And it's exactly what we see during his tenure. The basket of goods and services typically purchased by upper income earners, that top fifth, has increased the slowest. But the bottom fifth of income earners have seen what they typically buy go up the fastest.
Well, I guess that makes a whole lot of sense. I mean, consumers are generally pretty smart folks, and when they have to make cuts, they're not going to cut out the necessities. They're going to cut out the luxury items. So that makes 100 sense all the way around. So I'm really glad we were able to kind of hit this, look at, like we said, the basic necessities and how all those things have been impacted now just by simple, we say simple government overspending, but trillions of dollars of it is now impacting folks all the way down at the grocery aisle, and being able to look at how that goes. Let's go back to that jobs issue you were talking about. And so last month, the Biden administration just released a report for April, said they added 175,000 jobs to the economy. The previous month, it was over 300,000, I believe is what they say. So what is going on with those numbers you're talking about? You said a bunch of those are government jobs. You said half, right? Roughly half?
Over the last year, yeah.
Mm-hmm. Yep. So what is that story there with those numbers?
So we have a couple of big problems going on right now with the jobs numbers. The number that we're talking about right now is what we call non-farm payrolls. So we remove agricultural workers, and we do a survey of businesses, about 600,000 or so, between 600,000 and 700,000 each month. And we ask these businesses, how many people do you actually have on payroll? There's been this incredible divergence between that and the survey of households, where the survey of businesses has continued to go up, and the survey of households has been, frankly, anemic. It's actually been lower for a while now. Why is that? There's a couple of reasons that help explain it. One is the fact that when you survey households, you're asking people, are you employed, right? But if you go and you work a second job, you're now going to get two responses from a business on the same person. In other words, you get double counted as a multiple job holder. And we have some stats actually that show that the number of people with multiple jobs has been exploding. A lot of that's because people just can't make ends meet anymore. And so they're going out, they're getting another part-time job, sometimes a second or third one. Some some people are actually going out and getting multiple full-time jobs, where one full-time job isn't enough, so I go out and I get a second full-time job. So that's just one of the things that's helping to increase that number of non-farm payrolls without actually increasing the number of people that's employed. But another thing that's become really problematic, and this actually goes back to a disruption related to COVID, is that you had this tremendous number of businesses that were lost during the government-imposed lockdowns. I mean, you had the big box stores that the government essentially forced everyone to go to, or the Amazons, right? Mm. And the mom and pop stores, a lot of times, even with the gratuitous amount of government handouts, still weren't able to make it. So a lot of those businesses were lost. Coming out of the pandemic, though, there's been a just surge in applications for new businesses. Now, why is that significant? Because the BLS can't actually survey every single month all of the businesses that exist. And they also know that there are a certain number of businesses being added that haven't previously been surveyed. And so we need to try to account for all of this. Why? Because as I add a business, I'm employing people. Mm-hmm. Likewise, if a business is lost, what happens? Well, people are going to lose their jobs. So this explosion in startups, and not even necessarily businesses that actually get started, but just file applications, is used to extrapolate how many jobs are being added by those businesses. And the problem is that in the last month, that added over 300,000 to the total, which was more than the total, which means we're actually seeing a decline, but the birth-death model used by BLS has turned that into an increase. And this has been going on for quite a while, which ties into the third quarter of last year. There's a quarterly census that's conducted. And for the third quarter of last year, the economy didn't add 600-something thousand jobs, as the monthly job numbers originally indicated. It lost 190,000. Why? Because the quarterly census covers millions of businesses, not 600,000. So it's a much more accurate picture of what's really going on in the economy.
Funny how we didn't hear nearly as much about that number, though.
No, not at all. Well, but along those lines, I'm glad you brought that up. One of the things that continuously happens now with the monthly job numbers is you get one number, and then the next month it's revised down, and the next month it's revised down a little bit more. And you very rarely hear about that. You always hear about this blockbuster headline number. And one of the things that does, though, is, let's just take it to the extreme to kind of illustrate the point. Let's say we add 100,000 jobs this month, but then we revise that down to 0. And the next month we say, oh, we had a gain of 100,000, but we later revised that down to 0. So over the course of a year, it looks like you added 1.2 million jobs, mm-hmm. and you actually added none.
Well, that's bleak, but it's really interesting. You make the point that all these things are going up. The prices are going up. It's causing people to get second jobs, which is continuing to perpetuate the myth that Bidenomics and the Biden economy is not just healthy, but strong. It's the cyclical effect of honestly disaster that we're seeing currently coming from the administration. So you mentioned COVID and the COVID impact on the economy and the reporting that we're seeing from the administration. I'd like to go a little bit more into that, because that's another thing we don't hear a lot about as well, as obviously the government response to the COVID pandemic tanked the economy, not just minorly, but majorly. Many people lost jobs, lost homes. Many people ended up on the streets over government policies. Where's our economy at now in kind of that COVID recovery, and how has the Biden administration benefited from that?
It's a great question. Depends on how you want to measure it, I guess, is the short answer, right? How do we actually want to measure the economy, the health of the economy? You can do it in aggregate. You can do it on a per capita basis. A lot of different ways. And then the question is, what exactly do you want to measure? Do you want to use GDP? Do you want to use GDI? Do you want to use some alternative measure, right? So let's talk about a few of those. If you look at how much people can actually buy with their disposable income, in other words, their after-tax income, per person, that's gone down under Joe Biden by quite a bit, by thousands of dollars. If you want to look at GDP, yeah, that's gone up because the government's spending so much money and is going into debt. But what's essentially happening is we're pulling growth forward from the future to today. And the problem with that is, in the long run, it's very inefficient, right? In the same way that sometimes federal finance can kind of, I don't know, it can kind of seem ephemeral. So let's just look at it in terms of family finance. In the long run, how am I better off? Saving money in like a sinking fund for a new car, so that one day I have enough money and I can just buy it for cash when my current car dies? Or am I better off just not saving that money, just spending it on something else, and then when I finally do need a new car because my current car dies, I have to go out and get a loan? Well, obviously in the long run, I'm much better off in the latter case, saving the money and then not having to pay for not just the car, but all the interest payments for the next 5 or 7 years, whatever the case may be. Unfortunately, we're doing the latter, right? We are taking on all of this debt in order to pull that growth forward from the future to today. And not only that, but because of how we're spending the money, we're not even getting an increase in the standard of living that you would normally see if you allowed individuals to spend their own money on themselves, right? We're getting these wasteful Green New Deal projects that don't actually benefit anyone. I mean, except for the special interests and the politicians, right? They're making out just fine. But in terms of you or I, our cost of electricity isn't going down, for example. It's going up.
I think that's a really, really good way to put it in a simple but not oversimplified way of saying you're stealing that economic growth from the future and pulling it forward. I think that makes a whole lot of sense to folks. And when we don't even, I think it's safe to say we don't even know how far into the future we're pulling that economic growth from. If we're stealing from just our children or our grandchildren when we're doing that, it's truly absurd. And the people in charge don't care. They look for the gains right now for themselves politically, because that seems to be what they're most interested in, is securing power. And they'll mortgage the future or loan off the future in order to do that. At least that's what this sounds like.
Yeah, absolutely. It certainly is. And one of the really scary things, though, again, bringing it back to family finance, a family can get into so much of a fiscal hole that they'll never get out. And we are rapidly approaching that at the federal level. We may already be there. It's impossible to know, where exactly is that point of no return. But imagine a family spends so much money they don't have on credit cards. They rack up so much credit card debt that just the interest payments, the finance charges each month on those credit cards eventually exceeds the family's income. That's the point that we are approaching with the federal government. So what does that mean? It means that not only can you not pay off the debt, but just the finance charges, just the cost to service your debt is more than you can possibly pay, even if you cut out necessities like food, clothing, shelter, transportation. In other words, you're hosed. You can literally never get out of this mess.
All right, so that sounds like an interesting potential analogy kind of to the housing crisis and what happened with the housing bubble back in the early 2000s. Do you think there is something similar currently going on with how people were given loans that they couldn't pay for, and then were unable to pay them, and it led to massive government over control in the housing market as a response? What do you think is going to happen then?
Well, in terms of commercial real estate, we're in for a lot of pain. I mean, a lot of pain. The sector was already in trouble in 2019 before COVID. And now with so many people not using office space anymore, with the electronic economy, in other words, things like Amazon, right, where you just buying things online as opposed to in brick and mortar stores, that has really decreased the demand for commercial real estate. At the same time, interest rates are incredibly high relative to where they were. Historically, they're not that high. But the problem is with commercial real estate, it doesn't typically work the way a 30-year mortgage does. So you might get a loan for 5 years. It's an interest-only loan. Things like that are very common in the CRE world. And so what basically happens is every 5 years you need to refinance this debt. And you're not actually typically paying off the debt a lot of times, which means that you are highly subject to disruptions from interest rate hikes, which is what we've had. And a lot of companies rolled over. They did 1-year extensions of their loans last year, thinking that we were going to get a bunch of rate cuts from Powell and Company this year. So far, that hasn't materialized, which means a lot of these businesses are going to go under. When I say businesses, I don't mean the businesses occupying the retail space, I mean the people who actually like built
the retail
these
space, yeah.
Exactly, the people who built these buildings, the people who own the apartment complexes, et cetera. So I'm very worried about commercial real estate. Wouldn't touch that with a 39.5-foot pole. Residential, we're seeing a lot of problems because so many people took out massive mortgages in 2020 and even into 2021 because interest rates were so insanely low. And the problem is not that they overextended themselves then. It's that today, when they're spending 30 to 40% more on food, on energy, on necessities here, they're spending so much more on that now they don't have the same amount left to spend on housing, which I think is a key reason why you have steadily seen the number of people falling behind on their mortgage go up and up and up for about a year and a half now.
And that seems to be another thing that nobody's ringing the alarms on yet, but the last time we chose to ignore that, we also suffered the consequences. So hopefully we can get some massive changes here in Washington and start making some changes so Americans can get back on top of things. I mean, like we've discussed, generally people pay the right bills first, and if they're unable to pay those right bills, it should be a 5-alarm fire for everybody here in D.C.
Yeah, but ironically, the people here in D.C. are the same ones who have created that problem at the federal level, right? They can't pay their bills here, so maybe that's why they're so tone deaf when the American people can't pay their own bills. I mean, we're seeing credit card non-performance, which is basically defaults combined with delinquencies. We're seeing that rise at the fastest rate since the global financial crisis. Now, to be clear, the default rates aren't at the same level, but the rate at which they are rising is the fastest since the GFC. I mean, this is very, very worrisome. It's difficult to overstate just how much the American consumer is hurting right now.
Well, I mean, and like people don't want to take out these credit cards. They don't want to be doing these things for the most part, but they feel like they have no choice. And they're hoping that it's just a short-term problem. But as we've already stated, when it comes to debt, it just gets to the point where it spirals out of control and the people don't know what to do anymore. So we need massive changes. From the top down, we've already kind of looked at how all these things can interact, how simple government overspending of $1 trillion in deficit spending every 100 days impacts people at the grocery store and how that comes back and can impact real estate prices and things of that nature. So on top of that, something we haven't talked about but everybody is obviously aware of is housing prices in general have risen substantially. Housing younger couples and younger individuals out of the market from things that their parents were able to attain much more easily. We obviously saw something similar with the cost of education, particularly higher education, skyrocketing. What is going on with these things?
The very short answer is government spending. Again, that may sound like an oversimplification, but this is essentially what has happened. You have the inflation effect, right? But then there's also the interest rate effect. That has two parts. The first of which is that in order to finance these massive government deficits and try to bring down the cost of borrowing for the Treasury, the Fed pushed interest rates down to zero. And so that made it incredibly cheap to borrow. So because when you buy a house, almost everybody borrows, that's going to increase how much I'm willing to buy a house for. Much more than it would for a car, much more than it would for something like this microphone, whatever the case may be, things that you're typically going to pay cash for, right? So what happened with houses was there was an explosion in prices because I don't actually care about the home price when I buy a home. It may sound counterintuitive, but what you care about is your monthly mortgage payment. That's what has to fit into your budget. So over time, what we usually see throughout history is as interest rates go up, home prices just go down, and vice versa. It's very, very tightly correlated.
Because the payment then stays roughly the same.
Exactly. That's exactly right, because that's what people care about. So what happened, though, with interest rates being so low for so long, prices just continued going up and up and up and up. Then we got all the inflation. The Fed finally just belatedly hiked rates, and they had to do it hard and fast because they waited so long. And now you had this huge exposure of interest rate risk where let's say you got a home at a 2.5% mortgage, right? And now if you're going to sell that home and go somewhere else, you're going to lose that mortgage and you're going to have to get an 8% mortgage, which means you're going to be able to afford half the house. So how do you get out of that situation? You have to now sell this home for a massive premium. because you need all that extra cash in order to put down on the new home in order to get the amount you're actually borrowing down, right? Because as you increase the monthly payment, as you increase the down payment, you're going to decrease what you borrow, and therefore the monthly payment. So that has caused the price of existing homes or used homes to just completely explode on top of the existing increase that was already there from inflation. So that's the existing home market. What about new homes? Well, the cost to build a new home, we have a couple of different indexes that measure that. Both of those are at a record high today. In other words, home builders can't bring down their prices because they're going to be taking a loss. So those prices are also at a record high. And despite that massive increase on the part of home builders on new homes, the differential between used and new has shrunk to almost nothing, which has only happened a couple of times in history. But that just gives you an idea of how much the price of existing homes has gone up. So, all right. So what does all this look like for an average American family? Congratulations, you're going to rent forever. Why? Because the monthly payment, which again is what people care about, the monthly mortgage payment on a median price home, not a mansion, just a median price home, has literally doubled since January of 2021 when Biden took office. Doubled. Has your income doubled to be able to afford that?
I don't think anybody's has.
So, well, maybe, if you work in Congress, who knows? If you're as good a investor as Nancy Pelosi is. So what basically has happened now is an entire generation of Americans will probably never be able to afford their own home. Why? Because the cost of the home is so high that the down payment you need is so large that it's going to take you a very long time to save up that much money. And by the time you do save that much money, the inflation has caused the home price to go up further, which means you need a bigger down payment, so you still haven't caught up.
And you're chasing a moving object.
Exactly. And the amount you can save, people, I think, really underestimate today how much young people are unable to save. There's a reason why the savings rate, if you look at the nation as a whole, is literally half today what it was before the pandemic. Half. It's actually a little less than half. So that means that I don't have any money left over at the end of the month to put away into a fund that I'm going to use one day for a down payment. So I have less money to save. At the same time, I need to be saving more money for a down payment that's constantly getting bigger. That's a losing formula.
Well,
and rents are at a record high. I left that out too. So rents are at a record high. So you're stuck renting while you're trying to save up all the money to buy this home, or at least this money for the down payment. So rents being so high are another reason why people can't save any money.
I really wish we were able to give people any good news in this discussion about the state of the economy, but I think anybody listening to this would just be nodding along and be like, that's exactly what I'm currently experiencing, unfortunately. And I'd like to kind of shift that conversation into, let's start talking about solutions. Mm-hmm. Let's live in our dream world where Joe Biden is gone. His destruction of the family American dream that he's been pursuing for the last 4 years now is gone. Mm-hmm. How are we going to fix this in January 2025? If we have our magic wand, what are we going to do? Obviously, cut spending is the biggest thing. What else do we need to do?
I'm not sure you fix it in 2025. I think it actually gets worse then, for a couple of reasons. One is the fact that Powell has made it very clear with reducing the runoff in the balance sheet that he intends to inflate away a lot of the debt. So you're going to see another spike in inflation next year probably, and that's even if you get the government spending down. We forget that when the Fed moves, the market doesn't move right away. I mean, the stock market, right? Will respond like instantly. I mean, a lot of times they respond before he even does anything, just in anticipation. But in terms of the prices that you and I see, or the number of people that are employed, there's a big lag there. You typically don't get the initial effect until about 6 months, and it's not until about 22 months that you get the final effect of any Fed moves. So what the Fed is basically doing now is they were selling off U.S. Treasuries off their balance sheet, so reducing assets, which reduces the total amount of money in the economy. Now they are reducing the rate of reduction. So in other words, instead of selling off $60 billion a month, they're only going to sell off $25 billion. Why? Because it's providing wiggle room, or breathing room, I should say, for Janet Yellen, who is trying to sell trillions of dollars of these treasuries. And so it makes it easier for her to sell them because she's not competing with the Fed, who's also selling them. Just that's a very, very brief way of putting it. The problem here is that with other parts of the monetary system expanding, the Fed needs to be contracting even harder to counter that. Otherwise, what's happening is the money supply is growing, which is what we've seen over the last year. Despite the Fed increasing rates, despite the Fed selling assets to reduce its balance sheet, bank reserves have been growing. And it's from bank reserves that the rest of the money system comes. So you have banks lending, whether it's for a mortgage, for an auto loan, student loan, whatever the case may be. All of that is creating money. And as you repay that debt, it extinguishes that money. So as the Fed continues to allow the money supply to grow, whether that's the government going into debt or the consumer going into debt, you continue to have these upward pressures on inflation. And he has made it very clear that that's not going away. In fact, it's going to get worse. So this is remarkably similar to the late 70s, early 80s, where you had a spike in inflation followed by a massive spike in inflation, which was part of the reason why Reagan got elected. And the thing that's, again, particularly worrisome is that the government seems set on the path of, we're going to pay off this debt by inflating it away. And so you can look at, for example, the trajectory of how much we're going to be spending on the debt. It's literally a hockey stick graph. It's like when you picture a hockey stick graph in your head, that's what this looks like. And the scary part is the vertical portion of that graph has already started, and it's projected to continue and hit $2 trillion annually fairly quickly in just a few years. But what's interesting is that if you account for inflation, the real value of that is not that high in a few years. Why? Because if we continue to have these high rates of inflation, I, as the government, am going to pay you back with dollars that aren't really worth that much. And so, yes, I'm paying you back, wink, wink, but it's a backdoor default because I'm paying you back with money that's not worth very much.
Well, I quickly glossed over the idea of cutting spending, but I think what I'd really like for you to do, EJ, if you could, it's really tough for Congress to cut spending because there's always the fear campaign of, you're cutting all these benefits from these people, you're taking things away. It's very hard for lawmakers to vote to take things away. We have to start pitching to the American people that we have to start making these benefits for the good of our children and grandchildren. What would you tell them if you got the opportunity to talk to somebody about that issue?
Well, I think you're 100% right. The spending has to come down. That is the only long-term solution, right, is to get the spending down. How do we make that pitch? That's a really good question. I think the only way to do it is you have to illustrate for people that for every dollar you're getting in federal benefits, you're paying more than $1 in taxes, whether it's explicit taxes or the hidden tax of inflation. You're paying more than $1 for someone else's goodies that they're getting. And so this game of musical chairs, where we believe that the federal government is this magical vessel by which I can live at the expense of everyone else. Yeah, that's true, but it's true for everybody else in America too. And so I think you have to explain to people, look, what you think you're getting is not what you're getting. You're getting a raw deal because for every dollar you get, you're giving more than $1. That's why you're worse off today than you were 4 years ago, because the government's doing more for you.
Well, I think that's kind of an excellent way to kind of wrap up and bring everything full circle back to what we talked about, where this started with the overspending, how that comes back and impacts everybody in their individual pocketbooks, and then how us refusing to address that issue is going to only increase and continue that cycle. So, EJ, thank you very much for joining me today. We really appreciate you taking the time, and until next time.